Hi, and welcome to this new podcast series called Flow. We are launching this to decode liquidity matters in public and private markets. And to kick this off, we have a set of very special guests, the two Jayaramans, as I may call them. So we have Ganesh Jayaraman, MD and Head of Institutional Equities at Spark Capital Advisors. And we have our own Skanda Jayaraman, the CEO of Qapita Marketplace. So welcome, gentlemen, to this
Thanks
chat.
a lot. Good speaking to you here.
Thanks, Shrikant. Thanks, Ganeshram, for doing this. Appreciate it.
It was fine.
Wonderful. And we intend to double click on all aspects liquidity, but also more on the domestic factors as well. And we hope Ganeshram and Skanda will help us decode that. And what a time to have this conversation, right? We are living through very interesting times from a market's point of view. I think it's been a roller coaster ride, and that's perhaps an understatement. I think the benchmark indices have corrected maybe closer to 15%, and now has recovered in the last few days. Again, I'm seeing the market tanking today. So I think it's been a roller coaster ride. And coming to private markets, I think that too has seen some amount of rationalization setting in after the liquidity frenzy and unicorn rush we saw in 2021, 2020. So a lot of all of this obviously depends on the prevailing liquidity factors, and that is exactly what we want to kind of decode in this discussion. So with that bit of a context, let me ask Ganeshram to come in here first. Let's start with the macro standpoint, right? And there's a lot of factors here: the Fed tightening the rates. There's also the geopolitical factors involving Russia, Ukraine, and whatnot. So, and this has also meant that the Indian markets also, there's a liquidity pullout happening in the last few quarters, right? And now obviously there's a bit of stabilization that is setting in. So how do you kind of read this larger liquidity solution from macro point of view, and also the impact on the Indian
Great.
markets? Yeah.
So from September last year, we have been telling investors that a 12, 13-year cycle of easy liquidity will come to an end. So, but we are also very positive, very confident on earnings growth, or rather the growth recovery improving. So in other words, for last 12, 13 years, what we saw was growth moderating, but valuations in the financial markets were very, very strong. Or rather, in other words, if you look at half the world's bonds went into negative yield, negative interest rate trajectory, negative bond yields. Valuation multiples went through the roof. If you go back to how valuations were, say 10, 12 years back, and how they are today for the same companies, okay, in terms of pretty much the same kind, they're matured companies like in, say, consumer staples, okay, or IT companies. The valuation multiples are way ahead. So what we are of the view, and we've been having this view now for almost a year now, maybe slightly less than a year, that we should brace ourselves for lesser valuations, lesser liquidity, lesser money chasing asset classes, but more positive on earnings, on growth, on so this two dynamics, earnings and multiples, have very rarely been at the same direction. They tend to be contrasting, and we think around September last year this tilt happened. And of course, it doesn't happen overnight. It plays out over a few months, and central banks have been talking that language of sucking liquidity out, rising rates, making money costlier. Okay, and what has also happened is the baton is being passed on from a central bank led economy for the last 10, 12 years, pretty much from the financial crisis onwards. From there on, the baton has now got passed on to the governments. So we think, central governments will now drive the narrative. What I mean by governments is the fiscal policies, the government's expenditures. So they will now, especially post COVID, when the real economy suffered. Okay, so you are going to see money being put into real economy's hands. Okay, so that's going to play out in our assessment over the course of the next 2 3 years. Okay, in the form of capacity additions. So our real assets should start doing well. Real assets, I mean, it could be property, it could be mines, it could be capacities getting created. So the character of inflation, if you look at it, it's been more of supply constraints led inflation. So to address this inflation, you will need to create supply. So while central banks will try to cut, will not be able to achieve this, the government will take over. So you will find a change, that in this whole next 2 3 years, at least, maybe longer. But we need to calibrate. We need to figure out how it plays out. But our primary point is the baton has got moved from central banks to central governments. Liquidity will get tighter. Interest rates will be higher. We are well and truly on its journey. Valuation multiples will trend down. How we value exit, or rather what in investors terminology, what we call as terminal valuations, okay, will have to get moderated. Okay, so how we value cash flows will have to change. But the earnings growth trajectory will see improvement, especially in an Indian context. I'll
Right.
just maybe set this is the broad construct. Maybe
Right.
we'll zoom in as we go in.
Wonderful. I think that's wonderfully put, and I kind of, if I hear you right. So I think from a short-term point of view, there is that liquidity crunch that I think the wider markets will face. But I think maybe for the long term, it's all going in the right direction, given the focus on capacity and infrastructure, and also supply, right? And perhaps that might perhaps attract liquidity eventually in the longer run, perhaps, right? If I were to understand. Great, Ganeshram. That's a great starting point to now go over to Skanda, and shifting from wider markets to now private markets or private equity, right? And that's where Skanda is driving a lot of initiatives with the Qapita Marketplace. So Skanda, on one side, we are continuously talking about this funding winter, right? It's propping up in every conversation that we have. While on the other hand, we also are seeing that the largest of the fund houses have stocked up the largest capital ever, I guess, right? For Indian markets in some sense. So again, how do you read this situation playing out in the coming months and quarters? Again, maybe linking to what Ganesh Ram also just mentioned.
Yeah, no, absolutely. No, thanks. See, look, I think just taking off from where Ganesh was mentioning about how he feels, the valuations will actually correct, and more and more money is actually likely to chase the real economy. If you actually take a bit of a pointer from that standpoint, so again, just let's rewind back to 2008, 2009, right? The entire crisis was driven by lack of liquidity whatsoever, right? So people pretty much had zero liquidity whatsoever, and then if we were deal making back in the day, we would actually have very very few private equity investors in the first place who would even be willing to engage on a as interesting opportunity. So typically in these kind of markets, defensive sectors do well. And if you take real assets, and if you can include social infrastructure, like let's say healthcare, for example, as part of it, then these kind of sectors generally do well in these kind of sectors. But even then, back in 2009, you would find, we would be able to find only a handful of people who would even engage, because genuinely there was a liquidity strap. Today, what we don't have is that liquidity strap, and there is sufficient liquidity committed to the private markets, so to speak. But what the pockets of liquidity are doing is that they're holding back to ensure that valuations are actually coming back to saner levels, where you can justify a defensive return on a defensive investment, right? So I think you can't have again. So back to 2009, 2010, there was a wave of tech globally, a wave of tech companies that were just emerging, including the FANG stocks, right? They were not valued as much. And even in the private space, you had, by 2019, a lot of, I mean, Facebook had gone public, Netflix had realized value, and a bunch of things. And not just these two or three names, right? I'm saying across the board, $1 trillion of cash was harvested from private equity as an asset class. And that $1 trillion has actually come back to the same asset class globally, right? And what we are
Right.
seeing in India, therefore, or in this region, is a trickle down effect where you can easily count $20 billion from Sequoias, Accels, and all the popular names. You just do a quick top of mind read, you can easily count to $20 billion, and that's actually a substantial amount of capital when you think about it in the context of India, waiting to be deployed. But the thing is, obviously, these funds have a 10-year horizon and a 2-3 year kind of, or maybe a 3-4 year kind of an investment cycle. So I would say the funding winter is definitely going to last for a bit, not from the standpoint of money not being there, but that money is not going to chase anything and everything with frenzy. People are
Right.
going to be even more selective about where they're going to put their money in.
Wonderful. So looks like longer term prospects are good, but looks like the winter is more like a chilly day in Bangalore, rainy season. It just lasts for that few days maybe, and then hopefully it will be fine. Great. Let me now zoom back into what Ganeshram was earlier alluding to. So Ganeshram, you mentioned liquidity being pulled out. And we have seen that foreign capital actually has gone out. There are all kinds of numbers, and perhaps they have not yet come back in, but yet the wider markets are somehow holding up and rather corrected positively. In the last few days as well. So, wanted to understand or decode this whole domestic liquidity factor, right? Do you want to provide more color on this? Is it now actually shaping up maybe in the last couple of years? And you're seeing more and more domestic capital being deployed in equity asset classes. Do share any data or any insights on this if possible. Yeah.
Sure. So let's step back. If somebody had told us on Jan 1st that there'll be a war in the Western world, there'll be a oil spike as a result, leading to $120 a barrel, there'll be the extent of the kind of central bank action that we have seen, and still, if somebody had said markets will be giving positive returns for the year, maybe would have laughed at it, right? But that's the reality. And why is it a reality? And FIs have pulled out $25 billion from public markets alone in the first, and that stopped pretty much June end. Okay, pretty much July 15th it had stopped. Between July 15th and today, in just the last 6 weeks, we have seen some money come back. Okay, but the $25 billion pull out, had it happened in 2008, in 2013, or any of the last 20 years, markets would have been down 20% or more, maybe more. In 2008, we didn't even see this much of pullout, and markets corrected 60% actually. Okay, and the currency fell dramatically, so the dollar impact was even more for an investor. Okay, now actually, in spite of India being an oil importing country, our currency is outperforming oil commodity exporting countries like, say, Brazil or in Indonesia, or anyone. So India are actually doing very, very well, okay, as a country. And why is this happening? So I've been on road shows over the last 45 days taking my views on why I remain confident on the economic recovery in India. And when I speak to investors globally, what they are telling me is very interesting. They're saying, hey, we have sold India, no doubt. Okay, that is because of, by the way, we are not negative on India. We are still in an emerging markets basket of countries, including China, Brazil, and everything. We are still heavily overweight in India. Okay, India's weight is around 12.5%. In the overall MSCI basket, as we call, most funds I meet are telling we are about 20% on India. Okay, we were 25%. We have taken some monies off because what had happened was something very unique, wherein calendar 21, China fell 20% and we rose 20%. So and the currencies also helped the cost. So what happened was the relative weights for India went up dramatically, and with oil shock and the war in the horizon, funds started pulling money out, or from a risk management perspective, not really because of a fundamental view on India. It was a relative weighting standpoint, action. And what has happened is very interesting. What they are telling me is, if you speak to European, I was on a roadshow in pretty much 4 cities in Europe, and we also speak to funds in Japan or Australia or non-US investors. Okay, what when they tell me that we used to go to US before because we always had the comfort that there was a large domestic savings pool of capital available in US. So when we wanted to get out, there was somebody waiting to buy, so I could get out, and that gave us confidence. Now, as I said, 25 billion has gone out, and India has given them exit smoothly without market tanking, without the currency tanking. So the confidence that India can be a reliable country to get in and not be one Abhimanyu Chakravyu kind of getting in is easy, getting out is impossible, was always a fear they had. Now that's not there anymore. Okay, 25 billion has smoothly gone out, okay, without any economy throwing tantrums, okay, and that has given more confidence that there is a large domestic savings pool. Indian mutual funds, to answer your question, and this is connected to the question that you asked. Mutual funds on a monthly basis, they are getting about 10,000 crores of inflows on a monthly basis. Okay, and this is in spite of the non-SIP flows over the last 2 months turning negative. Actually, earlier it was both were positive. So that gives you the number. So over the last on a monthly on a 10,000 crores a month is like something like 15 to 20 billion dollars a year of domestic pool of money coming in. And even though foreign money has gone out, it's kind of offset each other and markets have remained stable. This is a very significant, from a longer term confidence on India. Okay, this I think has significantly improved the whole because India attracts a tiny speck of global pool of savings, and if this confidence improves, that 1% of total pool of savings becoming 1.5, and it has a significant bearing in absolute terms for us. And also keep in mind that structurally, funds are worried about China. Okay, and I'm not saying it will implode or anything, but just a view that China is not as growing as high as they were, or there are political issues, there are real estate issues there, and at a cyclically they are a little cautious on China, and structurally they're a little wary of the political issues in China, plus what they might try to do in Taiwan. Okay, Russia has already become an untouchable. Okay, and so where does money go? Okay, so so I was over the last maybe 2 months now, I know at least half a dozen funds who have raised EMX China funds. Okay, and in that category of assets, India and South Korea dominate. Okay, so this, though, in the funds who have raised this EMX China, they are telling me that there is a very strong appetite for such money. So what I'm concluding point for me is, I think that in spite of a roller coaster year, okay, I think as we sit here today on August end, I think the confidence on India has actually gone up vis-a-vis how it was, say, in beginning of the year. And keeping in mind our economic view and growth, which I will talk when at the right time. But broader question for me is the confidence has actually improved in a tough year.
Right. No, that's very insightful, Ganesh Ram. I think some of these numbers you mentioned as well, this additional pool of capital now being realized and further bolstering the confidence on India itself, further will give future dividends to us. So, Skanda, I would like to ask the same question from a private markets lens, right? So, you just heard how domestic capital is kind of bolstering our wider equity markets. How do you see this category also shape our private equity? Because I'm sure there'll be a trickle down, and also, anecdotally, I think there's a lot of buzz, right, with startups, unicorns, Shark Tank. It has become more a drawing room discussions now. So, what do you see? And you've been in the private market space. What do you hear? Are domestic capital being allocated to startup as an asset class? And how do you see this kind of pattern evolving into private equity? Yeah.
Yeah, no, so I think that's it's a slightly structural question, so I have to answer it at that level. Okay, so and again I have to compare and contrast it to how it was back in 2008 or 2009. So I think today where things stand is our estimate is that 20% of the domestic capital's portfolio is in some way linked to the private markets, right? I could be off by a few percentage points on the allocation, right? But the fact is, if you had asked that question in 2009, it would be less than 5%, right? Very, very, both in terms of the number of people who are indeed participating who could participate and indeed participating, and for the people who are participating, what percentage of their wealth is actually sitting in something which is linked to private markets. And when I say linked to private markets, there are two or three ways in which can happen. The obvious is people directly investing into it, the people then investing into funds, and the third bit is to, and one set of capital which is not very very intuitive, but I think is a very very big and looming corpus, is the surplus corpus that a lot of domestic insurance funds are sitting on, right? Just because of rising awareness of insurance as a product, for example, and therefore, what is the ripple effect that it has on private allocation, right? All of these three, if you add to it, our belief is that anywhere around 20% of the overall disposable surplus is coming into private markets, so to speak. Now, obviously, uh, what remains to be seen is that, on the number frequency, right? So obviously, the institutional funds are here to stay, the insurance funds are here to stay. But as far as family offices and individuals are concerned, they perhaps, for a lot of them, they are seeing this downturn for the first time, right? Now, to the extent that a lot of wealth has been created across this entire 12, 13-year cycle that Ganeshram earlier alluded to, there is some cushion already in to take some of the losses which people would have again mark to market realized out of their private investments, right? And therefore there will be some staying power. What I'm not able to at this point in time say is, therefore, the secular trend of people wanting to put the incremental 20 cents to the dollar in the next couple of years or not. I'm not so sure, right? Especially on the HNI and the family offices side is concerned. But capital that has gone into funds and is committed for the long term, I don't expect any pullback, from that. And look, to be honest, again, if you were to draw the spectrum of money that goes into private companies because of institutional funds, be it domestic or foreign in nature, but the institutional capital will dominate 95% of the capital of the money which is going into private market. So net net, I think we should be okay, right, in terms of how the private market should go.
Right. So there is additional influx, but still, I think the institutional capital will kind of hold fort. But there is new pockets of, I think, HNIs, family offices emerging as we kind of speak, right? So that's what I'm taking away. And I'm a similar question actually, taking on this point on capital allocation itself, right? Ganeshram, to you. How are you seeing allocation by domestic investors, right? I mean, of course, you track the mainstream markets, the equity markets more frequently, but then are you seeing with the clients you deal with other alternative asset classes also being preferred by domestic, both institutional and retail investors? What are your thoughts?
See, the big change on asset allocation is coming from real estate into financial assets. Okay, that is the key big change after forever, right? India has preferred property as their primary investing. I'm not talking of the just the top 1% of the savers. I'm talking of the next 5, 7, 10% of the savings population. Okay, that incrementally the incremental savings disproportionate amount is going into financial savings, and within that it could be public, private, or it could be various kinds of financial savings. But the big trend is from property into other asset classes. That's one. Second is even gold. Okay, from gold into other financial savings. So these two are a significant driver of financialization of savings, and that's where all the it goes back to the demonetization impact, the UPI as a the transacting tool having disproportionately gained, how we are seeing as phenomenal growth in GST collections or direct tax collections, both SME, large corporate, and individual tax savings. All these tell you about the organized character of the economy shaping up better. And as organized picks up, money goes into bank accounts, and instead of transacting as cash, and as it goes into bank accounts, the likelihood of it chasing financial savings gets better. So all these are actually interconnected. So to that sense, to me, the key point on asset allocation is this: at the margin, though, since kind of double clicking into financial savings, I mean, I track only equities, as you said. So I was asking some of my wealth management clients, or some of the friends that we have in the circuit. Their view is there has been a phenomenal confidence from even not just HNIs but also retail investors, that even if a stock falls 30%, and many stocks have fallen 30% this year, unlike earlier in the past when stocks fall 30%, they'll run scared. They're used to seeing markets go up, they go down, and it will happen, and they will find the exit gate soon. On the contrary, the first question investors are asking is, should I buy more, okay, instead of should I sell? So that's a kind of a vindication of the fact that 18 out of 20 years the markets have given positive returns. Okay, so and repeatedly investors have seen that even if it falls, sooner than later it rises again. So these give confidence for the retail investing, although if you can call the not the sophisticated investing population, the less knowledgeable investors also are behaving more mature. To me, that's a very important takeaway which I'm seeing from all these from a domestic investing pool of but having said this, I still think that at the margin, the pool of savings, some bit of it will start going into consumption. In the sense, instead of it going into stocks and others, if as opening up and as the economy revives back to its normalcy, it will go back into some bit of consumption. But in terms of automobiles or broader consumption getting normalcy coming back again. But the levels have increased at the incomes, in terms of bank balances, in terms of for example, I'll give you some numbers which are staggering actually. Pre-COVID, India used to generate about 3.5 to 4 lakh crores of annual CASA. Okay, CASA means current account, savings account, bank balances. Okay, that number is now at 7 lakh crores in each of the last 2 years. Okay, and so it's doubled the incremental pool. Where has this money come from? Forex reserves have gone up 200 billion, that's 15 lakh crores. So all these add up to the in terms of IT having wage hikes, more jobs. Okay, personal tax collections have gone up. So all this is more money in bank accounts, and as the minimum needs are met, okay, incremental pool goes into discretionary consumption. As food, shelter, clothing are minimal, then it goes into holidaying and transportation and everything. As that is met, it starts going into savings. So that there are multiple Indias within India. The one India where all this was already met, maybe that's about 3-4% of our population. That money is incrementally disproportionately going into savings, and that's going to be a very important domestic savings pool which I'm referring to.
Right. No, I think super insightful, Ganeshram, right from talking from the basics, and then how the trickle down effect is happening into various asset classes and getting more formalized, I think, into the banking economy, the savings economy. And perhaps, Skanda, I think I'm sure that capital will find its way to private equity, maybe in that journey, right? And that's what I think you are also observing and you just mentioned. So Skanda, just continuing the earlier discussion we had, and we discussed that how I think family offices, HNIs, these are all new category of investors now coming into private equity as well, not just indirectly through funds, but also looking at direct investments or opportunity for secondaries, for example, that you are also seeing nowadays. So the question to you is, how does one enable this access, right? And we at Capita are trying to build something around that, but somewhere that ecosystem is unorganized, right? So how do you see this evolving, and how do you build these rails, right? You want to allude on to that?
Yeah, no. So I think there are two, three parts to this question. Okay, the question we are asking ourselves in a way is, what is stopping from people who have the risk appetite to participate already into some of these opportunities, right? And if you ask, I think there are two things that stop them from doing it. One is there is a huge amount of information asymmetry, right? Unlike the public markets, where there is not so much of asymmetry on, let us say, price. There is not so much asymmetry in terms of what information I know vis-a-vis what information the other person knows. In a private market, it is completely asymmetric, right? It's almost like the other end of the spectrum. So if you put yourselves in the shoes of, let us say, a HNI or a family office, who do not have the access to data points where such information asymmetry can be reduced, then obviously the risk appetite translating into flows into this market is not going to happen that seamlessly. Okay, that's always been a point of friction that is reduced, and we are trying to see how through Capita and how through a digital platform we'll be able to actually reduce a lot of that information asymmetry across the board. And but this is a structural thing. It's going to take time for us to be able to do it, right? The second thing that we are seeing is today, and I think we have spoken about this before. If, let us say, I had to buy 10 shares of Infosys, I can easily log on to my app, whatever that is, HDFC Securities or whatever. Just place the order. By evening, I get the, the entire demat kind of credited, and my cash account kind of debited. Whereas in a private transaction, a buyer is found, a seller is found, the price has been agreed on, the entire process takes weeks, right? And if you understand why it takes weeks, there are a bunch of regulatory hurdles, including but not limited to, for a lot of private companies, the shares are not even dematted. But even if they were dematted in the first place, there are a bunch of aspects to take care of, from FEMA to tax, to the company's law, and so on and so forth, all of which happens through a very, very laborious process at this point in time. And that's another thing which Capita is trying to see, how those workflows can be completely digitized, made seamlessly, so that weeks can be reduced to a number of days. I don't think it can be as fast as how it happens in the public markets, because in the public markets, the infrastructure is developed over a 20, 30-year period, if not more. Whereas, the private markets, we're just about starting to say that we will be at the beginning of that chain. So we're talking of a really, really long-term kind of a build out here, right? So I hope that's answered your question, Shrikant. If there's anything specific, happy to kind of.
Yes, no, definitely. I think, and with those rails, perhaps there's more incentive for a wider, stakeholder group to participate in the private markets. And as you can see, there are also a lot of consumer brands, and there's an excitement for retail and HNIs and family office to start participating. So I think these rails would definitely help. So thanks, Kanda, for kind of telling us what is that, what are the Capita's plans in enabling this process. And would love to close this, and super insightful discussion, all this, and coming both Ganeshram from the wider equity side, and Skanda from private markets. I want to leave and end this discussion. Maybe Ganeshram, you doing a little more of crystal ball gazing. I think you've done enough already. But you also mentioned how the earnings growth will pan out in the, because of the structural shifts. How do you see the larger India story play out, right? Is it like are we really on a multi-decadal bull run, as many people said or have been saying, and do highlight any if you see any risks also in this whole process, right? Yeah.
Multi-decadal, I'm not sure, but we are quite positive on at least the next 3-year outlook. Okay, we think the fundamentals look good in terms of the fiscal side of things, the balance sheets of corporates, how leveraged the households are. okay, in terms of the dynamics of the currency, in terms of the priorities of the government in getting the capex cycle up and running. Okay, for us the largest expectation that we have is after 10 years, we think the private sector capex cycle will pick up. Capacity expansion will start across sectors like steel, cement. Banks have cleaned up their balance sheets. They are ready for next cycle of credit uptick. Will it all happen overnight? No. Corporates have improved their I think, I have not seen corporate balance sheets as strong as they are today forever. Okay, I mean, this, I'm not talking of I'm talking of the top 200 corporate balance sheets in the listed space. I've never seen it as good as they are today, sitting ready for the next cycle of capacity expansion to happen. Capacity expansion will be organic or it could be M&A led too. I actually do think that there will be an overseas M&A dominance which will actually start. India will start kind of putting that strong balance sheet to play in terms of M&A as well. So to me, the capacity expansion is a very important point. On consumption, while there are various, the balance sheet of households are strong, we do see, likely IT sector has been a big driver, or not just IT, the tech sector, the startups, the the wealth creation which has happened there, and the impact of that on I mean, you are in Bangalore, so we are aware of a dime a dozen uh, villa projects which have been bought by almost entirely sold on day one to individuals who are sitting on capital gains on the ESOPs they have monetized. So the how the impact of that on the consumption side of things has actually, you'll be very surprised at the quantum. We have had more than 35,000 crores of tax gains, which is with property being the tax efficient way to ensure that the tax outflow isn't high. You're seeing money flow there, so you will see some bit of slowdown happening, given that the capital gains are not there. In fact, last 6 months this would have dried up a fair bit, so you will see some bit of this slowdown. But the larger story is, for me, when I think, when I look at urban consumption, the rural recovery in consumption, the capex cycle recovery, the government's initiatives on getting electronic manufacturing, or all the PLI related, improvement on manufacturing. I'm actually very positive on manufacturing recovery play out in India over the next 3 to 4 years, maybe longer, but I mean, maybe somebody much more visionary can see through it longer, but with my limitations, I'm able to see it 3 years and
Right.
not beyond. But the 3 year outlook looks pretty good to me, though, and I think the rest of the world will see a lot of challenges in
Right.
terms of their impact due to commodity prices or energy prices and others. But I think India should see a lot stronger economic recovery play out over the next 3 years. That's our assessment as we sit today.
Wonderful. I think Ganeshram, that's a very, very optimistic note, I think, for us to end. And I think India seemed to be latching on to that proverbial opportunity that every crisis brings with, right? And I think we are trying to capitalize and, yeah, yeah, please.
Just to before one last minute though, I will not want to end without a note on valuations. I will still say that we need to, this the levels of valuation multiples which both public and private markets are currently there, we need to moderate it. So it will be like two, maybe three steps forward, one step back kind of returns, and not three steps forward followed by one more step of valuation upside. No, I think we need to moderate valuations, expand earnings, and that means you need to be selective on which kind of companies and sectors will see wealth creation over the next 3 4 years.
Right. No, wonderful. I think that point of caution is also equally important. So I think, yeah, broadly optimistic. Skanda, you want to end with
No, no, I think
any other thoughts?
broadly there, the risks that I see in addition to whatever Ganeshram just said, that I hope a lot of the noise around the private markets governance related issues is settled once and for all, because that can be one black swan event that can just act like a tsunami to destroy all the good work, right? So all the positives are there, all the we have enough tailwinds going in. There is enough capital committed. I think India is an entrepreneurial story that's never going to end. But the entrepreneurial story is only as good as how we govern ourselves, and so long as we don't see any major blow-ups
Right.
coming out of there, and of course valuations, or like Ganesh Ram just mentioned, um, definitely long-term positive. Yeah.
Right. Right. Wonderful. I think this was a super insightful discussion. I learned a lot actually from both of you, given the experiences and backgrounds you come from. And I'm sure our audience will also kind of find a lot of insights as they decide on their capital allocation and their participation in these wider markets. So thanks both of you, Ganesh Ram and Skanda, for this engaging discussion on this podcast, and hope to see you both again sometime. So thank you so
Thanks for
much.
having me.
Thanks.
A pleasure speaking to you.
Thanks.
Thank you, Ganesh Ram.
Thanks,
Thanks you,
Ganesh.
Skanda. Thank you. Okay. With that, we'll end this podcast. We'll come again soon with the next episode. So thank you so much for watching.